Saturday morning to you, and welcome to On the Mark alongside Mark Papa. I'm Gary Byron. Mark is with Financial Resources Group. They are out of Glastonbury, Connecticut. You can find them online at www.frplan, F as in Frank, frplan.com. More importantly, write this phone number down and call it. Well, hold on. We're doing the show right now. So at the end of the show, you can call right now. I don't want to tell you not to call right now, but I don't want you to go to voicemail. I want you to talk to Mark. 860-657-8380. 860-657-8380. Call today, call tomorrow, call Monday, call just. The bottom line is that you call. Mark, good morning, Mark. Great to see you.
Good morning, Gary. How are you?
I'm not too shabby. How was your Thanksgiving, by the way?
It was fine. It was great. We get to still spend a little time with the family and get together around the dinner table, which isn't something that we're used to doing anymore. At least traditionally, we used to do it, and then as the family gets older and the matriarchs and patriarchs pass along,
and we become the matriarchs and patriarchs.
Yeah, we become either you become that, or we become a little split apart. So it'll be good. It's good just to kind of see family.
That was. Did you see your family over the weekend?
Oh, yeah.
On Thursday?
Absolutely.
Good.
Yeah,
good. I know you have a little guy too, Andrew, right?
Yeah, Drew is gonna. He does. We split the day sort of, so he's gonna go out with his mother and grandparents and cousins, and I think they do Capitol Grill.
Oh, is that what they did?
Yeah, so I'll give a spot out to Capitol Grill. So they do a really nice Thanksgiving.
Very nice.
And my parents, it was just going to be my parents and me and I. So I said, hey, why don't we try doing something similar? And I called, every restaurant was booked. All the good places were booked. You couldn't get in anywhere. So.
Really? They're all booked on Thanksgiving, huh? Nobody does Thanksgiving at home anymore.
Unless you want an 8:35 reservation, but you're not going to.
So where were you then on Thanksgiving?
I was at my parents' house.
Oh, yeah, your parents' house. Okay.
Yeah, they're still doing well. So
I'm happy to hear that. I know your dad calls the show every now and then.
Yeah, exactly. Make the sides, make the turkey, nothing crazy. And usually I found out, it's kind of interesting. We used to get these big giant birds. When we used to have 50, 60 people.
Whoa.
And,
my goodness.
Oh, yeah, you'd have 50, 60 people.
I never had that.
You'd have tons of hors d'oeuvres. So by the time you got to the turkey, you were already full. But then you'd also have, pasta, meatballs, and lasagna on top of it. So it was just a huge feast. But, everyone wants to divide the food up and take it home, for the week. So
that's the best part. I think the leftovers, man, you end up having... leftover turkey. You have like 3 meals. Then you have turkey pie. You're gonna have turkey soup. You have turkey sandwiches.
Well, yeah, and you have to be careful. Before we get into the show, I saw a guy the other day. I was at the deli counter, and he was buying a pound of turkey. I'm like, Thanksgiving's 2 days away. Why would you do that? But anyway. To each his own.
Did you go out yesterday, Black Friday? Did you go out and get up really early and take advantage of some specials?
Absolutely not. No. I'll go to the gym and went to the gym and sweated out a little bit and just came home and relaxed a little. I'm not going to fight the rat race.
No, you're just old fashioned. I wasn't out yesterday, at least not for early shopping. I figure what I can get is probably so common. There's no special on any of this stuff. I'll just wait and get it. I got a month to get it between now and Christmas. So.
Exactly.
Oh, good.
There's plenty of time to get those Black Friday deals.
Well, yeah, they're not even on Black Friday anyway. If you notice, I saw it. It's all this whole weekend long. It's Black Friday weekend now.
Right.
So I figured today we're going to unpack the chaos in the markets as we hit really the home stretch of 2025. Tech volatility is off the charts with AI stocks in a tailspin. You got bubble fears are everywhere, and big names like Nividia and Oracle and even Michael Burry, they're all making headlines. So I figured that why not get the chief investment officer over at Financial Resources Group, Mark Papa, and let's kind of head into that a little bit. Let's dive in. All right, Mark. The tech sector's been hammered this month. AI stocks selling off hard. NASDAQ was down 7% from its October peak. And an AI ETF basket kind of tumbling even more. Investors, Mark, they are spooked about this AI bubble bursting. You got Bank of America survey shows 45% of fund managers are calling it the top tail risk. And we've seen a risk-off shift, growth to value rotation, and questions about when all this AI spending actually turns into profits. Mark, is this just a breather, or are we on the cusp of a bigger correction?
Well, I think a lot of people would like to have you believe we're on the cusp of a bigger correction. It sounds really sexy as an advisor to be bearish and play into everybody's fears and, let them know that, it's one thing. You can't just say, hey, stay the course when, but you have to be able to So what I wanted to do this show again is that, the waters have started to calm a bit. And I think a lot of the noise that was in the market regarding these individual stocks that, are Mag 7, which are mostly your NVIDIAs and your Googles and, the big companies, Microsoft, which they're calling the super scalers, are the ones that are backing and financing these large data centers. And they're not the only ones. We're going to get into a company called Owl Capital, who's also a darling of another area that I have a bigger concern about is the private credit market. I'm actually more concerned about private credit than I am the technology spend in AI boom, because I think we are in the very early innings of that. Long term, I think the capex and the spending, it is an arms race between us and China. I think the smart companies realize that they're going to make the investments. But I want to get into some specifics. I mean, the bad news is that the good news is we didn't even see a correction. A correction is 10%, Gary. We saw, I think, maybe 8% for the Nasdaq, so we didn't even really see a correction. Some of the bigger companies, the other darlings like Palantir and NVIDIA did take a hit. And I just also want to say this does not constitute investment advice. And please contact a licensed professional before making any decisions. So this is not, also neither an offer to buy or sell securities. So this is purely informational. And, hopefully people will see. I think the big thing to do, like we've been preaching, Gary, is to diversify your risk away from the Magnificent Seven and own them. But you don't want, 7% of your portfolio in one company. You should have maybe 1.5% to 2% of your max position, maybe in Microsoft or NVIDIA. But it's hard because they're now $4 trillion companies, Gary.
Yeah, but AI isn't going away.
It's very, very early in the game. No, it's not going away. And I think the amount of spending and the amount of capital commitments that are happening are pretty serious. And you can just see that as evidence in NVIDIA's latest fiscal third quarter earnings. The revenue hit a record of $57 billion, and that's a big jump year over year. But their profits were $31.9 billion. They beat expectations on both the top and bottom line. Now, Gary, what that means to the listeners, on the top line, that means they beat the revenue, and on the bottom line, they beat the earnings. So top and bottom. So top line is beat on revenue. Bottom line is when you beat on earnings. So guidance, they actually raised their guidance to $65 billion over the next quarter and crushed estimates. Their Blackwell chips are selling like hotcakes, and the stock did among a broader sell-off. And they were questioning Michael Burry, who is of Big Short fame, was really trying to make a case for that they're depreciating. They're taking longer to depreciate their chips in the data centers. And then many people pointed out that, it went from a 3-year cycle that they used to depreciate to a 6-year cycle. But a lot of people pointed out that the reason they're doing that is that there's many, many chips that are still running in these data centers that have that are 6 years old, and they're still running. So that makes it fair game. That's what they call GAAP accounting, generally accepted accounting principle. There's nothing illegal about that. So for him to try and make the case they were inflating their numbers, I think he was a little dated on his data. I'd also add in the fact that even NVIDIA's lowest end chips, lowest end, oldest models, Gary, are sold out. So, anything, people are buying whatever they can get their hands on at this point.
Speaking of AI leaders, Nividia, just dropped their third quarter fiscal 2026 earnings last week. Revenue hit a record $57 billion, and that's up big year over year, with profits at $31.9, nearly $32 billion, beating expectations on
big
both
number.
both top and bottom line. So you got guidance for $65 billion next quarter, crushed estimates too. You got Blackwell chips selling like hotcakes.
That's exactly right.
Yet, listen to this. Stock dipped amid the broader sell-off. So what's your read? Bullish signal or more bubble fuel?
Well, there was definitely some consolidation in the stock, and that's going to happen from time to time. Anything that goes straight up is probably really dangerous. And let's face it, it's not trading at the cheapest valuation. However, what I would say is, if you take a look at their future growth prospects, it could be not exactly overvalued. So that's the struggle between what the market's saying. But the fact that all we want to do is talk about Nividia is a little nerve-wracking to me, which is why, again, we diversify from having it 6-7% of the S&P to down to 1 to 2% of the S&P, because you do never know. You never know. Most recently, there was Google announced that they were going to buy Meta, and Google are in talks to buy chips from Google, and the stock dipped from there. Now, the good news is not everybody's bullish, Gary. When everyone's bullish, that's time to sell, okay? When everyone is bullish in the market. So we do have a lot of naysayers, and we do have some dark clouds hanging over the market, a bunch of them, which is good. And the market's been fairly resilient, and I think it was kind of due for a sell-off. And I'm not really overly concerned about the long term. What I am concerned about is gaps in how quickly we can deploy these data centers, gaps in what the market's concerned about is when's the profitability. Because you talk about any new technology and any hot technology, just like the internet, just like AI starting in 2022, they're selling you the future, Gary. The story is the future. Eventually, we want to talk about the present. What's the present look like? When are we going to see profitability? What's your P2P? Path to profitability. When are you going to start making money on these things? And will you be making enough to service all the debt you took out to build these things? So we're seeing a lot of criticism on Oracle. And Oracle is Larry Ellison. I don't know if you know him. He's one of the wealthiest people in the country. And interesting enough, Oracle has borrowed a significant amount of money. Its bonds are down about 8% in October, and they did an $18 billion issuance in September for AI data centers, feeling debt worries. So their total debt reached $96 billion after a $38 billion loan. And those things that they call credit default swaps started spiking a bit. And the credit default swaps were what Warren Buffett, he basically considered, financial weapons of mass destruction. So when people hear credit default swap, they get a little nervous. But basically, what a credit default swap is Gary, I'm going to pay you 5% interest, and then you're going to pay me if my house burns down, basically. So credit default swap it's there to default. You're going to pay interest. You're going to assume a default risk. If the default risk goes up, so does the interest, and then the price of the default credit default swap actually goes down in value. And if you're short, it goes up in value. That's how they made all that money in the housing crisis. So, that's basically the story there. So people are kind of raising lots of concerns about the ability for companies to continue this spend and borrowing and service the debt mainly. And then you have another group of, this is an interesting story too. Have you heard any stories about a company called Owl Capital?
I have not.
Okay, well, Blue Owl. It's called Blue Owl, and they've been in the news going back over a year ago. Gary, I was in New York City at Gallagher's Steakhouse.
Oh, nice,
great place.
Yeah,
whole room of very, very smart people smarter than me. And there were one of the representatives from this company was there talking about his new exchange traded fund, and it was a private lending fund. So it was an exchange traded fund for private loans. And I've been reading the news, the headlines, just like the AI bubble, potential. Blue Owl, Ares Capital, private credit, and then I hear a lot of advisors talk about how they feel so exclusive, like talking about private credit to their clients. We're going to get private credit. And private credits are private loans. They're outside the banking system, Gary. And banks essentially have just become the originators of the loan, but they don't hold them on the balance sheet anymore. What's been happening is the loans that they don't want, they'll keep. The loans the loans they want, they'll keep. The loans they don't want, they're offloading into these large, massive private credit funds. Now, the other problem with these private credit funds is they're going to be offering them, they just passed a law, they're going to allow private equity and private credit in 401k plans. Now, my feeling is it makes it look like we're democratizing. Well, not only the rich can get the private credit, not only the accredited investors can get the private credit. But once the little guy starts having access to the private credit, here's my feeling, get what they're doing. And this is not, don't take this the wrong way. And please don't take this as an accusation. But usually by the time all those deals reach the small guy, there's no deals, all the good deals are taken. And basically what ends up happening is the little guy starts putting their money in, and all they're doing is offloading the bad deals to the little people. So you've got to be very, very careful as to who you work with. And if your advisor is telling you to get into a private credit fund, you have to also be careful because there are fees. And there's also situations where you may not have liquidity. You can't get your money out. And that's what happened with Blue Owl very recently, where clients wanted to start taking out some money. They were restricted in getting their money out. And then they were one fund was going to buy another fund, and I'm being very generic in this explanation, at a 20% discount, and the shareholders balked because they wanted to offer daily liquidity. But then what happens in bad times, they can't do that anymore. So it's great. You got the best of both worlds in this high. So, but I think the main concern I have about the private credit market, and I called this back at Gallagher's, I said to the gentleman who was trying to get us to, look at his exchange traded fund, I go, how many deals are there for all the amount of money? I see billions of dollars, hundreds of billions, 50 billion being raised here or there. And I said, how are there that many good deals to fuel the funds that you're raising? And in that, what ends up happening about a year later, I was back at Gallagher's and with the same group of people. They weren't there, and I was like, I said to myself, "Do you remember that call I made?" Because I kind of called the guy out pretty hard, and he didn't have an answer, and we were just kind of laughing about it. And already there's been 3 or 4 major questions, more major defaults that were private credit. And if you look at where these stocks are trading now, Gary, if I was smart enough and bold enough, I should have shorted them and went with my gut, and I would have made a bunch of money because those stocks are now down significantly from their peaks. So I'm not saying that there's another crash coming there. There's another bubble. But again, here we have a risk. It's shadow banking, meaning it's banking that is outside the purview of the Federal Reserve. Of course, the Federal Reserve needs to know what is actually happening in there, but it's not the same level of regulation as you get with a bank.
Folks, you are listening to On the Mark with Mark Papa. I'm Gary Byron. Mark is with Financial Resources Group out of Glastonbury. You can find him online at frplan.com, and you can call and meet with Mark, have a discussion with him. There's no obligation. 860-657-8380. As a matter of fact, you can even ask him how you could obtain a $100 gift card. So he's very easy to reach, 860-657-8380. You mentioned a little while ago Michael Burry, and because he's been vocal. He's been claiming that hyperscalers are actually inflating earnings by depreciating AI chips over like 5-6 years when their useful life is shorter, like 2 or 3 years, calling it a fraud. Yeah. And that understates costs by really billions if you think about it. But some say he's wrong, as GPUs don't obsolete that fast with software updates extending life. So, Mark, where do you land on Burry's depreciation cycle critique? Yeah,
as I mentioned earlier, Gary, I think he's off the mark. I think
no pun intended.
He missed the trade. Yeah, exactly. So let's talk about what a GPU is. It's called a GPU is a graphics processing unit. Okay, it's a GPU, graphics processing unit. There's all sorts of different types of GPUs we won't get into today. But, you have NVIDIA's chips, and they're multiple chip, the Blackwell chips. You have all sorts of different chips. But, going back to that, Gary, where I was talking about our friends at the Blue Owl Capital, they're lending out significant amounts of money for AI data centers. So they've already lent $450 billion. Think about that number for a minute, Gary. Wow. Yeah. And then they also have a $27 billion joint venture with Meta, which they're going to own 50%, the Hyperion Center in Louisiana. And I saw a picture of this Hyperion Center, and when they say it's the size of Manhattan, it literally could fit on the island of Manhattan. That's how massive this thing is. So, again, if you see cracks in the armor in the private lending market, this is the these are the people guaranteeing or backstopping or up these large data centers, and they start having cracks, and then you start seeing cracks in the AI trade. Michael Burry made a point, and at first I didn't really understand where he was going with it. I think it looks good on paper, but I think he's going to be wrong on this one. I think he's going to do what he can, and hopefully he covers his short and moves on, because I think he's going to end up losing in the long run. But that's up to him. It's his money.
All right. Well, fair enough. Let's talk Oracle then. Their bonds are tanking, down 8% since October. With that, $18 billion issuance in September for AI data centers fueling debt worries. All right, so you got total debt nearing $96 billion after a $38 billion loan and credit default swap spiking. So, is this a red flag for the AI debt binge, or?
Well, yeah, as I mentioned earlier, I think there's a possibility that can happen. I don't think they're going to default. I mean, Oracle's a solid company. I think they're definitely ahead of their skis, and they're long in the tooth on what they're borrowing, but they must see some opportunity. And Larry Ellison is, one of the smartest guys in tech. He's one of the richest guys in the world. So I not people that you want to bet against. So I don't think that. By the way, just full disclosure, I do own Oracle personally. Mm-hmm. I'm not selling my shares. I'm going to stick with it.
All so right. Tells a lot.
I think there's and again, just in any sell-off, the bears always want to look like geniuses. They're right, like a clock. They're right once a day or once in a while, So and then they all want to be. Everyone wants to be a hero, becoming a bear, but you go broke very quick. And there's a saying, markets can remain irrational longer than you can remain solvent, and that's why many short sellers are actually closing their doors and currently. Burry's closing his as well in his fund. But with that said, Gary, there's another area I want to talk about is the crypto market, and I also want to end on interest rates.
Go.
So the crypto market, we had a massive sell-off in Bitcoin.
Just this past week?
Right, and then they're talking about another area, Michael Saylor at MicroStrategy, worried about him going into the S&P 500 because essentially he's essentially a Bitcoin hedge fund. What's interesting is when the value of Bitcoin's come down so much that, people got margin calls. They were borrowing money to buy Bitcoin. There's also what they call derivative-based Bitcoin, two-time Bitcoin products you can buy that are leveraged. And leverage is great, is lovely on the upside. It's like a sugar high on the upside, but it's murderous on the downside. And I think there was a couple of people that went bankrupt on the demise of Bitcoin. I think there was some YouTube influencer. I can't remember the story, but it gets ugly. It's a sell-off. We're shaking out the weak players. But I think long term, Bitcoin's going to be just fine, and not too worried about it. But it's something that has to be brought up just because it was a pretty ugly. Of all the sell-offs, Bitcoin was the ugliest. Crypto was the ugliest.
But it'll rebound, I would imagine.
I have a strange feeling it will. And it'd be good if we can get Manny back on the show to talk about that. Maybe we'll do that next week.
Or the week after.
Loyal listener. And, also, Gary, I also want to talk about the Federal Reserve. Because, Elon Musk said something really interesting. And, we need, whether we need a rate cut or don't need a rate cut, rate cuts are good for borrowers and lenders, but rate cuts aren't designed to bail out bad loans. So even if we get rate cuts and there were bad loans done on some of those, like private credit, rate cuts don't bail out bad loans. Bad loans are bad loans. Doesn't matter how low the interest rate is. Took on too much debt, can't pay it. That's not going to help. So I think there could be a bigger problem brewing in the behind the scenes at some point. But I think from a rate cut, it has been a very weird Federal Reserve. I think we're in transition with what we're going to do with Jay Powell. And then who is Jay Powell's successor going to be? And I know just the other day, Scott Bessent, our Treasury Secretary, was basically spot on about all the confusion between the Fed governors. Many of them are acting independently. Many of them, and it's a bureaucracy, so that's good. Right? A democracy, excuse me.
I was going to say, bureaucracy is never good.
It's a democratic bureaucracy. So what's happening is there's a lot of confusion. We're missing some government data over, some of the government data that we would normally have collected that we missed during the government shutdown. So there's a lack of clarity as to what they should do on interest rate policy. So one of the reasons we saw the market sell off also is that the likelihood for a rate cut dropped from 50% down to 30%. And now it's back above that number again. So
you think there'll be a rate cut before the year's over?
It's in such a tough place because, everyone's barking about inflation. Inflation's down significantly from its peak, dramatically from its peak. Everyone wants to bark affordability. And I get it. I just saw an article today where a giant fry from McDonald's is $4 now. That's a problem. However, think about it. If you really put that into perspective, maybe McDonald's fries are the best French fries. Maybe they should charge a premium for it. If people are
buying them. That's capitalism,
if
isn't it?
People are willing to pay for it. There you go. What is someone?
But remember, during
COVID, fries today?
They were hiring people at $21 an hour during COVID. Right?
Yeah. No,
we're paying for that now.
Yeah, and another thing is we still are working our way around that. I think the jobs market is fairly healthy. I think we don't have to create as many jobs as we used to because of mass deportation or voluntary, whatever we want to call it, reverse immigration. And I think there's going to be a lag in the economy in the short run. But you know what? Those gaps are going to get filled like they always do. I'm not overly concerned. But yeah, I think it would be nice to see a rate cut. Just to make sure we have a backstop in the economy. I want to go on record saying I'm 100% against using $2,000. Everyone's going to get massive tax refunds next year.
Yeah.
The OBBA is going to be, I think, tremendously stimulative, which is another area where we have to be careful. You don't want growth and inflation eating up the growth. So what I would say is I think the consumer and everybody's going to be just fine. It's just we're kind of in a lag period.
Put the $2,000, put it out towards the deficit.
Yeah. Put it against the debt.
Yeah,
That's
put
right.
It against the debt.
Pay down debt, just like we did in the 90s.
Folks, head on over to Mark's website for Financial Resources Group. They are out of Glastonbury. Their website, www.f as in Frank, frplan.com. Or give him a call and ask him how you can obtain one of those $100 gift cards. But bottom line is, because you're going to get more than a $100 gift card. When you sit down and talk to Mark, he's going to set you up for the rest of your life. 860-657-8380. Again, 860-657-8380. For Mark Papa, I'm Gary Byron. Thanks so much for listening to On the Mark. Until next Saturday morning, have a good one, everybody. So long.